Good evening. My name is Rudi, and tonight we're going to be discussing CFDs. Um, now, what is CFDs? Now, CFDs is contract for difference. Now, how it basically works is it's almost the same as what how equities work, where you buy certain stocks and then later on you can go and sell your stocks. But the only difference between the two then is that yes, you can buy both, but then you don't actually own the CFD. That's why they call it a contract. Okay, so a contract is something that the bank still owns, and then equity is something that you own within the company itself. So if you buy a share, you own the company, and then you basically grow as the company grows. Um, and if the company makes losses, you make losses with the company. But with a CFD, if a CFD grows, then obviously you grow with it. If a CFD goes down, same principle, but then there's a little bit more of a risk involved towards if you're looking at exposure. All right, so with a normal equity, if I open this notepad quickly, if you're in an equity and you put in 1,000 rand, that 1,000 rand will be worth 1,000 rand. Okay, so that's what basic equity will be worth. All right. So if you are trading the CFDs, you will have a chance. Let's say you invest 1,000 rand. That 1,000 rand can be a potential of 10,000 rand. Okay, because of a gearing ratio or a leverage, and then also that the bank gives you a margin on top of what you invest. Okay, so if you take let's take a share like for instance SSW. All right, so SSW has a, let's say, leverage. So SSW has a leverage of 7 point of so, yeah 7.4. So that means with whatever value I put in, it would be timed by 7.4. All right, and then the bank basically borrows you that margin. Okay, so if you put in on, let's say, this investment, 1,000 Rand, that investment or trade will be worth 7,400 Rand. Okay, so the bank is loaning you amount of 6,400 Rand. Okay, so that we call the margin. Okay, so 6,400 margin, which they basically loan you. And then also, if you want to basically find out, okay, what is the price that I'm paying per share, then what you do is you take the margin percentage. So you first need to work out what the margin percentage is, which the software shows you, which I'll show you now. The software shows you what the margin percentage is that you're paying on the original price per share. So if you take, for instance, a share is 10 Rand, okay, and the leverage is 1, then it means that you're paying a full price of 10 Rand. Okay, if the share price is 10 Rand, okay, and then the leverage is equal to 2, you will be paying a margin of 5 Rand. Okay, so the higher that goes, the less you will be paying per share. Okay, so you'll be paying a lower price per share. So if we take it to, let's say, a software side, and I go say buy shares, I select the CFD simulation account, and then I enter my number of shares that I would like to trade. So let's make it a leverage of 1, okay, with 100% margin. So then I put in 1 share, then I will be paying full price per share. So it's 56 Rand 24 cents. So that's what the share price is worth, but the required margin would also be the same, 56 Rand and 24 cents. Okay, but on top of that, obviously, you will have brokerages. So your brokerages on our software doesn't show you the brokerages, but if you're trading through the institute, like for instance, FNB or Standard Bank, they will show you what your brokerage will be. In the case of Standard Bank, it's 57 Rand 50 per buying transaction, and when you do a selling transaction after that, then you will pay the same amount of 57.50. And obviously, if you kept the share, let's say overnight from today to tomorrow, then you will pay an overnight fee, and that's a small percentage usually. Okay, depending on the amount that you put in. Okay, so if I raise this now to, let's say, 5, leverage of 5, that means that I'm paying a 20% margin. So I'm paying 20% of the original price. So 20% of the original price is 11 Rand 25. Okay, so I'm only paying 11 Rand 25 per share. So the higher your leverage goes, the higher your, or the lower your margin will go. So if I had a perfect 10, my percentage margin would be, would be 10%. So I'll be paying 10% of the original price, which would be 5 Rand 62. Okay, so every share has its own leverage, of course. Okay, if you're looking at Sibanye Stillwater, which would be more or less a 7.4, which would give you a 13.51% margin, and that's of course on one share. So if I take another share, then your required margin will go higher. Okay, so the more shares you buy, the higher your required margin will go. But then you will see that your total cost on the right hand side will also go up, but that is what we call the exposure. So you will have a higher exposure for a higher amount of shares that you buy. Okay, so obviously at a cheaper price, you're not going to be paying full price, you're going to be paying a marginal price, but the bank will loan you, as I showed you on the notepad here, the bank will be loaning you a certain amount, so X amount on whatever the amount is that you are investing, and it also depends on what the leverage is per share. So if I change this to 2, obviously then your required margin will go up. Okay, so required margin will go up because now I'm only paying 50% of the last price. Okay, I'm only paying 50% of what the current price is. So that would be 2,812 Rand. Okay, which will give me a total cost of 5,624 Rand. So it's not going to stay the same because I'm still taking the same amount. All right, so but if I take a lower leverage, over a higher leverage, right? So that also means a high leverage or gearing ratio means that your exposure in this case would stay the same. Your required margin is less, but because your leverage is higher, it means that you're sitting at a higher risk to reward. Okay, so equity will have a 1-to-1 ratio. All right, so you'll always be paying full price per share. So it means that if the company goes up by a certain percentage, then you're only growing on that amount that you put in. But in this case, you're putting in 760 Rand. Okay, 760 into the share. You've got to just go back to that quickly. Let's take that 7.4 again. 7.4 with 100 shares. So I'm only paying 760 Rand, okay, with a total cost of 5,624 Rand. So I'm putting in less, okay, but my risk is higher, right? The risk is higher, meaning that my total cost is higher than what my required margin is. So if you've got a higher required margin, then your risk isn't that big, because now it means, in this case, it means that if I have to lose this 760 Rand, okay, then I will have to pay in to get back to that total cost of 5.6. So the institute or bank that you're trading through can expect that from you, or they will just take from whatever is left in the account. Okay, so they can take whatever's left in the account. If you don't have enough, they will ask you to pay in an extra amount. Okay, because not only that you lose your money, but you're losing on their money as well, because they're borrowing you a certain percentage. Okay, so I'm just quickly going to wipe this. So once again, we've got, let's say, 10 Rand per stock. All right, with a leverage, it's like 5, will give you then 5 Rand. Oh, sorry. So leverage of 5, let me just make sure of this. Yeah, leverage of 5, which would give you a price of 2 Rand. Sorry, so 2 Rand per share. So you're going to be paying 2 Rand per share on a leverage of 5, because you're dividing it your amount by the leverage, and that's basically how you work it out. So it's like whatever your leverage is, divide or whatever your price is, divide that by the leverage, and that will give you a percentage margin that you will be paying per share. Okay, so obviously when you make money, it's the same as when you lose money. right? And another thing is with CFDs, you can trade in both directions. So that's why we've got the open long and open short position. So not only will you be able to buy in an upward trend, you will be able to buy in a downward trend as well. So instead of trading for the market, you're trading against the market. That's one thing that you can do with CFDs that you can't do with equities. So Forex markets work the same principle. So they also give you a leverage. They also give you a margin percentage that you're paying. They've also got a small little brokerage that you need to pay, but it works on the same principle when you're trading down or up. So you can trade either against the market, so that you call a short, or you can trade with the markets, which you call a long position. So if you go in a long position, you start making profit, you will be making profit more or less on a leverage of 7.4 and not on a 1-to-1 ratio. So your profits may be higher, or even your losses may be higher, depending on which direction the share goes from the time you open your long position. And the same with a short position. So you can make money in both directions. Okay, so usually we just work on the software with the leverage of 5. So for those that don't have a Standard Bank account yet, or a FNB account yet, then you will need to use the average of 5. If you're trading with the FNB, obviously you're not going to have a 5. So if we can quickly go over what the banks basically offer you. So ABSA, they don't do CFDs, so they don't do any derivatives anymore. Standard Bank, SBK, they've got a leverage of 1 to 10. So it can be anything. So it's not a perfect 10. All right. So don't expect that you put in 5,000 Rand and it's going to be worth 50,000 Rand immediately. All right. That's unfortunately not how it works. You need to go and pull up a quote on that share to see what the leverage is. FNB has a lower, so FNB, they've got a lower leverage. So the leverage would be anything from 1 to 5. And then I think Nedbank NED is the same. They've also got a leverage of 1 to 10. I might be mistaken. It might be a 1 to 20. But then if you're trading through, I can't remember the place's name exactly, but there's another company that you can, IG Markets. So that's the place. So IG Markets, same thing. It's a 1 to 20. So they've got a bit of a higher leverage. So, but just remember, the higher that leverage is, yes, your exposure would look excellent. So if we say, for instance, we've got a 20 on a margin, I mean, I'll be paying 281 Rand on the stock with 100 shares. So it's 5%. No, sorry, yeah. So sometimes it's a margin of 20%, but it can be up to 20 on the leverage. I think the lowest margin percentage is about or highest margin percentage about 30%. So then you can work out some percentages. Usually with them you need to go and fill in the percentage, but it can go up until 20% on the leverage. So they've got really high. But remember, the higher that leverage is, the higher, yes, your exposure would be really high towards what your required margin is, but then your risk is higher the higher your leverage is. So 1 to 10 ratio is 100%. Okay, so you don't need more than that. If it's 1 to 5, it's still a bit low, because I mean, then you're trading, like for instance with Sibanye Stillwater, you'll be trading on a 6.2 leverage and not a higher leverage of 7. Just quickly see here. So we have a question. If there's any questions, you're more than welcome to ask, and then I can. So how does the bank make money? They will not loan you the money to you, as they can't make. Well, they actually do make money if you take the brokerage fees that they charge you. So remember, there's not only you that's trading on the market, or 4 or 5 people that's trading on the markets at one time. I mean, there's a lot of people that trade on the markets at one time. I mean, if you go look at the volumes that's been traded through the day, it's not only equity trades, it's CFD trades as well. That can have a huge influence towards any type of stock. If you take, for instance, CLS clicks, if you take since their breakthrough, you'll see sometimes that there will be a huge spike. All right, for no odd reason, there will be a huge spike. There's no fundamental news behind that huge spike. So what will happen is, if you go look at, then you'll see that it's more or less CFD traders that is pushing the price. Okay, and all of those trades that happen, obviously cost brokerage fees, and those brokerage fees is what the bank make. So yes, they loan you amounts, and then also if you keep the share overnight, then obviously it's like an overnight fee that they're charging you. So the same if you take out a loan, then you pay, let's say, 27% on top of that loan that you've made, right? So they make money with the interest overnight, and also with the brokerage that you're paying for those transactions. Okay, so obviously the banks do make their money in a certain way. Okay, so most of the times, most banks, I mean, if you look at how a bank works, they will make money with interest rates from your money, and sometimes they do reinvest whatever you put in. So if you're saving your money with a certain company, you think that your money is just lying there and it's safe, but it actually is being reinvested so that they can have a certain percentage. And then obviously then you get a certain percentage back. Over, let's say, a year, you will maybe gain, if you're lucky, like 6% interest on your account. And that interest is basically what they've made by reinvesting. So banks do make their money, even though we think, but how do they pay their people? It's mostly brokerage fees and interest. So that's one thing on how banks work. Okay, so interest would be the main thing on how they will make money off of your trades. So yeah, so even though if they're loaning you that amount, you will be paying 57.50 per trade for your buy, 57.50 for your sell. That's around 15 rand. And then you can look at the amount of trades that's been done for a day. Sometimes you'll find like anything from 4,000 to 10,000 trades for the day on a share. And you look at the amount of the volume amounts that people have bought. Work out the calculation around, let's say 7,000, let's say at an average of about 5,000 trades times that 5,000 by 115 rand for the day. So obviously they've made their money from your brokerage fees. Okay. So it is possible for them to do it. Um, so Impala Plat, so okay, we've got another question here regarding Impala. So let's quickly go to IMP. So IMP. So currently, okay, no, I'm not opening correct in the correct tab. IMP, so Impala Plats. So if you're looking at any um, iron ore industry or platinum industry, especially with BHP. So the same thing's happening with them. So there's a lot of fundamentals currently running around on certain companies. Like for instance, iron ore is being influenced currently by China, and same with platinum. Platinum is also being influenced by the Chinese markets and a lot. We pulled up BHP just if I can quickly take BHP as an example. So BHP, if you take this drop, there's a gap, literal gap in between here. There's no lower candle for a lower price or a higher candle for a higher price in between these 2 days. So the market basically dropped, and they're currently stuck on making a decision on 5 or 6 different companies that they need to make a decision on with who are they going to go in partnership with, and it's Chinese companies that they need to decide on which one is going to be the best for them to make them move forward. And obviously investors are watching it. So some investors will have it will have a negative influence on them. They will rather sell out and wait a while. So once the market drops like that, remember that is us making the markets go down. That's the investors out there making the markets drop. I mean, without investors, the market can't go up. A company can't grow without investors. So if investors decide to get out of a company, then that's basically what's going to happen. You will have a drop in the company. So currently BHP needs to make decisions. Kumba Iron Ore, for instance, had a big decision to make towards how many apps they had to sell towards China. And now that's the same. It's the same with all the other companies in South Africa. I think there's two mining companies. I think it's AGL Anglo that needs to merge with another company. And that's also going to have a negative or a positive influence on where the company is heading to. So fundamentals are a really strong thing. if you're looking towards where a share is going to go. And if investor gets scared, then it might scare off other investors as well. Then they will sit on the sideline and wait. And that's why this share is basically having a sideways movement. So they didn't really drop lower than what it dropped yesterday. They had a big green candle for today, and then it just came back. Okay, so it dropped basically below yesterday's opening. Okay, it didn't drop below the close, but still it's in a negative since yesterday. So the share will have a slight sideways motion now that you can see on the RSI and stochastic. RSI is moving up, stochastic is moving down. That tends to move a market sideways. Okay, so fundamentals, really important thing, and that's also what I base my SMS notifications on, is on fundamentals, not only technical analysis, because technical analysis is one thing, but if you don't have the news behind a company, then I can say, okay, let's go buy the share or go look at the share, but I don't even do any fundamental analysis. Then you're not really just going to believe what I say on a technical analysis. You need fundamentals. Fundamentals is sometimes really important towards, especially investors. But for a trader, this would have been a good opportunity for a short. So if you were trading a CFD, once again, this is now what I've explained earlier. If you're trading CFDs, you can trade downwards as well. So this would have worked in your favor if we put in a short at the top here. So you could have put in a short on an opening of 464 rand and 89 cents, and you could have closed the position on 421 rand. Right, so it's a 40 rand drop. All right, just a little bit more than a 40 rand drop. You can say 43 rand drop within a day. So that would have given you a slight advantage on a CFD. Okay, so the drop here is even greater than what the climb here was, or more or less the same. So there was a big climb here for a good CFD trade in a long position, but over here you had a short opportunity. All right, so you could have made money in both directions. Okay. Just trying to get to the other questions. I think that's only 2 questions. But if you've got any other questions, you're more than welcome to ask. Then I can answer them for you. I'm just trying to see if there's any others. Usually, yeah, there's only 2. Okay, but if there's any other questions, you're more than welcome to ask. If you don't want to ask it now, you're more than welcome to send me a mail to rudy@sharetrackin.com or send us a ticket, and then I'll be able to answer your questions on it. Look, CFDs is also it's not, I wouldn't say really new to us, but there's a lot of questions around CFDs, especially like how is it possible that you can make money in a downward trend? But I mean, as I said, it's more or less the same as CFD, as Forex. Forex, you trade against the market. So you trade against let's say, for instance, you're trading a pair of, let's quickly just go to stock movement view. It's just going to be, no, sorry, it's on the world market indicators, but you'll be able to trade different pairs of shares. Let's say the US dollar versus the ZAR. All right, so that's a pair that you're basically trading. So you're trading against the ZAR. All right, you're trading against the South African rand. So there's all the pairs that we've got available. So Aussie dollar versus the South African rand. So you're trading against the rand. So you're predicting that the Aussie dollar will go up if you're trading in a long, but you're saying that the South African rand will basically go down. So it's you're not trading for the South African rand, you're trading against it. If you're trading against it, you will go for a short. If you're trading with it, you will go for a long. All right, so you're just saying that either the South African rand versus the dollar is going to go up or down, and that's the same with CFDs. CFDs works in exactly the same principle. You're still trading with shares. It's still normal stocks. It's everyday normal stocks that we all know. It's just you're not trading for a long term, where an investor would go and buy down here and sell way up there. But for a trade, you're not going to buy in November and sell out in March, okay, of the next year. You will only be trading it for a week or two, at max, at least 2 weeks, okay, and then get out. Because in 2 weeks, a lot can happen. I mean, this is more or less a 2-week trade, and then it went down. So that's another shorting opportunity. for another, let's say 2 weeks, and then it goes up for another 2 weeks. Drops for 2 weeks, goes up for a little bit longer. So you can basically just ride the waves up and down with CFDs. Okay. But yeah, I think that's it for tonight for the CFDs. I mean, if there's any other questions around CFDs, you're more than welcome to send me an email to rudy@sharetrackin.com, support@sharetrackin.com, or go to contact us, and then use any of the contact numbers, and then I'll be able to answer any of your questions. So I hope you guys have a wonderful evening further, and then we'll speak next week again.